Okay, welcome everybody. Welcome to Navigating the Markets with Elliott Fibonacci and Harmonics. No, they're not here today. It's just me, Jody Samuels. But I want to welcome you to the Chicago Traders Expo. I know you've taken time out of your busy schedules to be here. It's a pleasure for me to be here from Toronto, and thanks for coming out today to learn about a topic that I am so very passionate about, that I've used my entire trading career, and hopefully I will impart some knowledge to you today that will keep it simple, because I know many of you are new to these theories. So I'm going to try to keep it simple and whet your appetite so that you want more afterwards. You want to learn more afterwards, because I can't trade without Elliott Wave analysis. So why don't we, and Fibonacci and Harmonics, and I'm going to show you some really neat things today. So why don't we get started? Please read the disclaimer to yourselves. And for those of you who don't know me, my background is as an institutional trader. I traded Forex for a major investment bank on Wall Street for 15 years. And now I have my own business called the FX Trader's Edge, where we train traders like yourselves to navigate the markets using these methodologies. That's me, and this is my book that I'm very, very proud of, The Trader's Pendulum. It's my first book, and I don't want to say my last book. I like to joke it's my first and last. But it really is. It's called The Trader's Pendulum, The 10 Habits of Highly Successful Traders. And it's a book about managing your trading business, managing your trading account. It's a really, really fun book, and check it out on Amazon. Just check it out. I'm told that it's an excellent read. I have some students that have read it many, many times. So I think there are 3 pillars to trading success, and you've heard a lot of people talk this in the last couple of days about what makes them successful, and this is what I've come to after my 30+ years in the market, that one needs the analysis, the strategy, and the coaching and the accountability. Let's talk about the analysis first, but really, why do we need all 3? It's like climbing up a mountain. Are you going to climb up a mountain without your supplies? No. You need all the tools to do that. You need all the tools to set up your trading business. So let's talk about the analysis. A key pillar of achieving consistency is to have a thorough knowledge of the market, to determine possible future scenarios and be prepared to take advantage of opportunities that arise. In our system, we use Elliott Wave and Harmonics in order to have market context and increase the likelihood of successful outcomes. So the analysis is about having the context to see what's out there, looking at doing a top-down approach, looking at the bigger picture is another way of saying it. It's like trading the markets. Trading the markets, you need to also have a fundamental picture. What's going on with the fundamentals? Is there something hot for the week or the month, like easing or raising rates? Right now we're currently in a raising rate environment. So that's what I call market context. That would be part of the analysis, getting the big picture context. So the big picture context, wearing my Elliott Wave hat, would be to understand what the bigger time frames are doing in the market, whether you're trading stocks or whether you're trading currencies or whether you're trading futures markets. It's all the same. You want to get the context. So we use Elliott Wave analysis to get the context, to get the big picture. And then we can use our strategy. This is the second pillar to reaching the path to success, is to have a highly effective strategy which is easy to understand when making a trading decision. After a good analysis, strategy is used to identify the exact entry point, stop loss level, and profit target to know when to trade and when to stay out of the market. Removing the emotions is key. Who here isn't emotional when they're trading? Is not? Okay.
I assume you decided strategy before the market started.
you have your strategy intact before, when you sit down to your trading session, the first thing that I do is I analyze the Elliott Waves, I look at the fundamentals, I see what's coming out for that day. You know, the markets are driven by a lot of event risk and news risk and announcement risk and all these other risks, so you want to be prepared. The strategy is something that you develop over time. We use the wavy tunnel strategy. That's what we've developed. It has an Elliott wave bent. Whether you use indicators on your chart or you look at price action, that is the strategy. So if you have a breakout strategy, or if you have a trend strategy, if you have an end of trend strategy, these are the strategies that you use. If you use moving averages, that's part of your strategy. You dress up your chart. It's like you have a picture in front of you. You dress up your chart with your indicators if you use them, or your trend lines, your support and resistance, your pivot points, whatever it is you use, and you know exactly what needs to happen for you to pull the trigger. And that's how you set your trade plan up. You identify your exact entry point. If we go above this level, I'm in, I'm buying, I'm long. And where is my risk? This is my risk. So that will help you determine the size of the position that you're going to be taking by the amount of risk that you will take on every trade. You've heard a lot of speakers this week talk about being successful because you keep your losses small. And that's exactly the truth. That's exactly the truth. And I'm going to show you something that we have as part of our service. I mean, this is not a marketing pitch at all. I'm going to teach you something today. But that's exactly what we do in our trading alert service. We keep our losses small and we ride our profits. And we've been very, very successful doing that. So strategy is very important. The third pillar, coaching and accountability, the team. To combine all the knowledge and apply it properly, you need the third pillar, which is coaching, an expert to evaluate your trades and give you feedback to correct the mistakes and polish the entries and the exits. Accountability is key. Even if you grab a trading buddy to share your trades with, plan your goals, and receive feedback from. It's really important that you are accountable to somebody, or it could be a group. Maybe you're part of a trading group. Otherwise, it's just too easy to get into your own head and make your own decisions yourself and decide that you're going to keep the position when you really need to be getting out. At least if you have a trading buddy, you can be accountable. You can say, okay, I made a mistake today. I kept my position for too long. I ignored my stop loss. You know, it's good to be accountable. Who can attest to that? It's good to be accountable. Otherwise, all havoc can break loose in our heads, right? So, yeah, everybody agrees. That's great. So let's do it. Let's do it. All right. Let's get down to the nitty-gritty analysis. I really have a lot to cover, and we started a little late. Ralph Nelson Elliott studied various market indices over a 75-year period in the 1930s. Actually, he was bedridden with the virus, and back then, it was all manual charts, all hand-drawn charts, and he had all of these charts, reams and reams of data that he went through manually, and what he discovered was that the stock markets traded in repetitive cycles, and that these cycles or waves reflected the emotions of investors. So when when traders are exuberant, we're in a wave 3. The exuberance shows up in the price of the market because everybody's buying in a frenzy. You know that feeling when you want to get long and you can't because the pullbacks are too shallow. That's what a market frenzy is. So that's what he discovered, that the cycles reflected the emotions. And when the markets are sideways, it means there's no news coming out, there's nothing driving the market, and investors are sitting back. They're waiting for other investors or traders to make the first move, and they're saying nothing's going on. Well, wrong. That's really the time to do your analysis and to get ready for the next move. It's like a lion in the den, waking up and going out and looking for its prey and just waiting and watching. I don't really know how lions operate. I'm just making it up. But you've got to be prepared for the market cycles. So we're going to learn about the market cycles. Now I want to tell you about Leonardo Fibonacci, an Italian mathematician born in the 12th century. He is known to have discovered the Fibonacci sequence of numbers, a sequence numbers after 0 and 1, where each successive number is the sum of the two previous numbers. 1 plus 1 equals 2, 1 plus 2 equals up. And this sequence is fascinating because if you divide 55 by 89, or 89, golden ratio, 0.618. And if you go backwards, which is a retracement ratio, and if you go backwards, 144 divided by 89, 89 divided by 55, all the way down, you get 1.618, which is an extension or a projection ratio. So the common retracement ratios are 0.382, 0.5, 0.618. They're all based on the Fibonacci sequence. And the projection ratios that are very common, 1.618, 4.23, these are the inverse of the retracement ratios. And it's all generated from this Fibonacci sequence. So Leonardo Fibonacci did good, as did Elliott, in terms of furthering research to make money in the markets. Now, the wave principle states that patterns are tied to collective human behavior related to Fibonacci numbers. Elliott is very much tied in to Fibonacci. So if we look at this 8-wave market cycle, can you see this? Is this, yeah. 8-wave market cycle, 1, 2, 3, 4, 5, trends are formed in 5-wave sequence, 5-wave movements. So 1, 2, 3, 4, 5, that's the trend move, and ABC, when it's lettered, it's the corrective move, the correction. So when you see an Elliott wave count that is numbered, that's the trend. When you see an Elliott wave count that is lettered, that's the correction. Now, in between, you have, when you have a 5-wave sequence, you have corrections. Waves 2 and 4 are the corrective waves. And waves 1, 3, and 5 are the trend waves. So in this whole picture, you have the trend waves are waves 1, waves 3, wave 5, and then wave A and wave C. The corrections are 2, 4, and B. So why are the corrections 2, 4, and B? Because they have letters A, B, C, A, B, C, A, B, C. And why is wave A and wave C of the correction a trend? Because they're numbered. They're numbered. That's why. So one of my favorite trades is to trade the C wave down. So once the market moves down and we have an 8-wave cycle, 5 down, 3 up, this is one of my favorite trades, to sell for the wave C down. And we can measure the C wave move based on our projection ratios. My minimum target is 100% of the wave A. So I will measure 100% of the wave A. An extended move would be 1.618. So the personality of a C wave is very similar to that of a wave 3. You see, this is like the inverse. 1, 2, 3 looks like ABC. So what I tell my students is, you don't have to go crazy counting waves and understanding whether it's this correction or that correction. There are different types of corrections. All you need to do is to trade the 3-wave moves. And what do you care if it's the 3-wave move that will end in a 5th wave, or if it's just a 3-wave move? Because that's the safest trade, to trade a 3-wave move. So that's one point to take home today. Always trade in threes. You have your first trend move, which is 5 waves, and then you have your correction. You can always trade that third leg. Everybody get that? Makes sense? Okay. Keep an open mind for a paradigm shift. Old ways won't open new doors. So I'm going to challenge you today to keep an open mind for the rest of the presentation and to really, I'm going to try to keep it simple, but I'm going to teach you some things that are probably going to open your eyes a little bit. And you might have some aha moments. So just keep an open mind. So this is the 8-wave cycle that we just looked at. And by the way, Elliott Wave is all about chart patterns. I think you probably noticed a lot of head and shoulders at market tops and bottoms. I didn't point them out. But Elliott Wave analysis is based on the classical technical analysis chart patterns that you are all familiar with. The head and shoulder patterns would be the end of the move. The rising wedge is a diagonal in Elliott Wave terminology. A triangle is a triangle. Triangle in classical technical analysis is a triangle in Elliott Wave analysis. So you're going to find a lot of similarities. All right, this is your 8-wave cycle again. 1, 2, 3, 4, 5. I just want to point out where you would trade in this 8-wave cycle. And we've already discussed that you would trade the wave 2. So you have a 5-wave move up for wave 1. And then your 3-wave correction. So you can buy that for the wave 3 move. Now, you can also buy the wave 4 for the wave 5 move, but sometimes the wave 4 can correct for a while. So we're not even going to get into strategy and how markets can correct for a long time, but you learn that over time. You need to really, I'll just give you a clue. If a market, if you think that a wave 5 is going to continue from a 3-wave wave 4 correction, and we trade up in 3 waves, it means that the correction isn't over yet, because corrections move in 3s. So that's why the easiest moves to get would be the 3-wave move. Many people get chopped up in the wave 4, and there's a lot of profit taking going on in the wave 4 by institutional traders. But there are lots of traders that want to buy for the next move, and sometimes there is a next move, and sometimes there isn't. Sometimes the correction just lasts. You go ahead.
So you always have a wave before you have point zero, right? So always say which one is wave 1 and this one?
Yeah, I do. So that's a good question. His question is, how do you know that the end of the move has happened? So I'm going to show you before the move in the next direction starts. Okay? I'm going to show you a little strategy on the next few slides on how to determine the end of the move, the end of the trend. So just hang in there. And then finally, your wave B sell to trade to sell the wave C. Okay? And we're not even talking about the stop losses. I'm just trying to get across the major points to you today. There's so much to teach, obviously, right? Even
more to learn.
Even more to learn, okay. It's all doable. Everything in small bites, yes?
Buried in the technicalities. Cynical question, if you bear with me. Sometimes I step back and I look at these techniques and think that they're like a self-fulfilling prophecy. That somebody observes it, they're read well, becomes popular, people start trading on it, which just adds more evidence to the validity of the original premise. Because everybody's trading to make it happen.
Right.
It's really a representation of something else, something physical manifestation of the universe or something. You know, the sun pulses.
Okay, so this is a very long question to answer, and you can say it's a self-fulfilling prophecy, but Elliott, Fibonacci, it is all tied to, like Fibonacci shows up in architecture and art Leonardo da Vinci paintings, the way he builds the body, it's all based on the Fibonacci ratio. So there's something more to it, but it's not for this class. Okay? But thanks for the question. Okay, I'm going to show you, I want to show you one thing. Notice how in this picture, how do you know that the trend is continuing? Well, you can draw channel lines around the trend, and most of the time the trend will stay within the channel lines. And here are some examples. So here is a 5-wave sequence of the S&P. It's an hourly chart. 1, 2, 3, 4, 5 in orange. You can see that for the wave 3 over here. That breaks down the wave 3. And wave 1 in red circled orange, 2, 3, 4, 5. That's a 5-wave sequence. So as long as we stay within the channel lines, there's no need to decide that the market is oversold and the market is going to turn around until we break through these channel lines. Elliott wave cycles stay within the channels. Just know that. Now, we already discussed the personality. The wave 3 is the greatest move for profits. Wave 2 retraces wave 1. The market hasn't fully decided yet that the new trend has begun, so it's not very obvious that the market is going to move down until we take out this point here. That establishes a new trend. We trade down for wave 1, up for wave 2, and once we take out these low prices, then the market knows that the market is trading down. So that could even be part of your trading strategy, to ignore this sideways consolidation and only get in once we break down. Okay? Here's another example. Okay, this is Bitcoin, a 4-hour chart. So here is your 5-wave sequence, 1, 2, 3, 4, 5, all staying within the channel, and then what happens? The market breaks down and it retests the channel line. And again, the wave 3 is the greatest move for profits. With the wave 3, sometimes it's very difficult to get into a wave 3 because it's moving very quickly and the retracements are very shallow. The wave 4 is your retracement, and then the wave 5 usually makes a high above the wave 3 top. And then it's over, and then we have the correction. Here's another one, gold. This is a daily chart of gold. 1, 2, 3, 4, 5. I've just drawn the 5-wave moves in between, but everything stays within the channel. So the first point that you're going to remember is to draw your channel lines on the market moves. Even if you can't count the waves correctly, there is no right way to count the waves. There are many, many wave counters out there, and I think if you put 10 counts together, they're all going to be slightly different. It doesn't matter because we're traders first. We want to make money. So you're never going to find me arguing with someone over their wave count, ever. Okay? But what I'm going to look for is I'm going to say, well, okay, this wave count is bullish, my wave count is bullish. Great. It's going up. You know, that's... We don't want to get stuck. Now, I told you that I was going to give you a little formula for determining a change in trend. So this is it. Let's start on the left side with trend. With trend, you usually have oscillator convergence. So what are the oscillators? The MACDs, stochastics, RSI, those are the oscillators. Oscillator convergence, meaning when price goes up and makes a new high, so does the oscillator. The oscillator also makes a new high. That's called oscillator convergence, and you see that during a trend. You also see the price in the channel, which we've already discussed. And you see 1, 2, 3 trend continuations. So 1, 2, 3 trend continuations, if you look at this little arrow here, you have point 1 at the start, point 2, point 3, and once we take out that high, that's called a 1, 2, 3 trend continuation. Okay? It's a pattern. Change in trend. With change in trend, we see divergence. Divergence is when price makes a new high, but the oscillator does not. So price makes a new high and price makes a lower high. Okay, I'll show you examples. And we also have the trend line break. So price is coming out of the channel. And we have a 1, 2, 3 reversal pattern. So let's look at some examples now. Here's the S&P chart that we looked at before. Now let's dress it up and analyze what we just learned. Oscillator convergence. Price is going down, and the oscillator, this is the awesome oscillator, by the way. This is the oscillator that I use to find the end of trend. This is the oscillator I learned with Bill Williams back in the 90s, and I learned this from him. So the oscillator makes a lower low. It's consistent with the trend moving down. Correct? You see that? What's also happening is price is within the channel, and we have 1, 2, 3 trades. We have a 1, 2, 3 trade over here. We have a 1, 2, 3 trade over here, and these are mainly breakdown. One after the consolidation, the market sells for the next trend move. Now, what happens at the end of this move? Well, this is what I'm talking about. We have divergence. So let's look down at the oscillator and see what I mean with the divergence. Do you see the oscillator makes a higher low? Price makes a lower low. The oscillator makes a higher low. That's your first clue that momentum is running out of steam, that the market might be turning around. That's your first clue. The next clue is it actually does. You have a trend line break. So price moves out. So then you're going to say, well, fine, well, how do I get into the trade? That's where your 1, 2, 3 reversal comes in. And this is your first 1, 2, 3 reversal point. You would draw a line across and leave a stop buy above this level, if you wish. But then look what happens. It doesn't trigger until we have another 1, 2, 3 reversal setting up right here. So then you can bring it down a little bit and use this level or keep this level, whatever you choose to do. And then you're in the trade. So remember these points. Let's look at a few more examples. I'm going to skip this example. Gold, okay. So we have the 5-wave sequence moving up. 5-wave sequence moving up. Now this is an ending diagonal in Elliott wave terminology. Okay, an ending diagonal, a rising wedge in classical technical analysis, right? A rising wedge. So I'm drawing the connecting trend lines around the wedge. So what happens? We have divergence. The oscillator histogram is not making new high with this high in price. We have a trend line break, and we have a one. These are the things that you can look at. Now, what I would tell you also is that you can go down to the smaller time frames if you want to get in at a more precise level. Now, what would be the value in that? The value is once you get experience behind you and you're getting really good at calling these market reversal points, because this is what we're discussing right now, you can take a bigger position because your stop loss will be smaller. That's really why you would go down to a smaller time frame. If you don't go down to a smaller time frame and you trade on this time frame, your money management just it has to be the same. So you're going to risk the exact same amount as you would risk on a smaller time frame. You might have to take a smaller position, right? Because your stop loss will be bigger. But it doesn't matter, all right? So here's another example with the Aussie dollar. We have a 5-wave move trading down, and look what happens. Here we have divergence. We have divergence. We have triple divergence. So the market is running out of steam here. We have triple divergence. Then we have a trend line break, and the 1, 2, 3 reversal pattern happens actually before we break up. So now you're beginning to see that not all trends and corrections are created equal. Every market is different. But clearly, this broke out after we had this 1, 2, 3 reversal point, and you would have had to go down to a smaller time frame to get a 1, 2, 3 reversal once we broke out. This is the 4-hour chart. So we broke out, and then the market moved up. So change in trend, divergence, trend line break, 1, 2, 3 reversal. Now, now harmonics. Since so many of you are new to Elliott, you're probably new to harmonics as well. How many of you are familiar with harmonics? Right, that's what I figured. So you're not going to get the aha from this bit of work that I've come to understand by linking Elliott wave analysis with harmonics. See, there's been a lot of work done on harmonics, and at the beginning I showed a book. Scott Carney is the work that I respect for harmonics. Okay, he's written a number of books. And Robert Prechter is the man that I respect for the Elliott wave work. He took Elliott's work and really made it available for us to study. So, but what I've done is I've linked the harmonics with the Elliott wave analysis. So from my perspective, if you can have two giants, analysis giants, confirming each other, wow, that gets me really, really excited. If I can see synergy between a harmonic pattern and an Elliott wave pattern. Now let me show you that. I'm not going to even go through this because I'm just going to show you the picture, and this is just to whet your appetite. Here is the 8-wave market cycle for Elliott. A harmonic pattern is exactly the same thing. It's like an 8-wave market cycle. You have the first leg, XA, so call that your 5-wave trend move, and then you have your 3-wave move. So now let's look at some examples. This is called a Gartley harmonic pattern, and I'm not going to get into the Fibonacci levels and the Fibonacci ratios that comprise the Gartley pattern or any other harmonic pattern. I have a full course which does that, and you can read Carney's books. So I don't have time to teach you what all the Fibonacci measurements are, but just look at the pattern. This is just incredible. Here is our 5-wave cycle, and then the 3-wave correction. Everything that we just learned about. So with the harmonic pattern lining up with our 3-wave correction, this is the point at which the market should turn around. So far we discussed how you get into the trend by buying on the wave 2 and the wave 4, and we discussed how do you get in on the correction by selling on the wave B, the 3-wave move before the wave C down, correct? But what we didn't discuss is what happens after that 3-wave move ends. Well, what happens is the trend usually starts again in the original direction. So we have trend, correction, trend. That's the pattern. So if we can line up a harmonic pattern on this 8-wave Elliott wave cycle and come up with a precise level to buy based on Elliott wave analysis measurements using Fibonacci and the harmonic measurements, how cool is that? That was the biggest aha moment for me, and honestly, I studied harmonics several years ago, and I only made that connection 3 months ago. So this is all new, okay? I have many other connections with harmonics and Elliott, but when I saw this, it just blew me away. Yeah?
You said normally wave C is twice the length of wave A.
Good question. So my minimum target is 100%, the same length as wave A. That's my minimum target for wave C. Sometimes the wave C is shorter. If the trend is really, not often, but sometimes it is, if the trend is really, really bullish, You just get the market buying, now everybody is looking at the same level, self-fulfilling prophecy. So if everybody's looking at the 100% level, it might not get there. It will be shorter.
Maybe I'm short of wave C. For me, I have trouble recognizing then how do you know it, I guess then how do you know it is a proper wave C, I guess? In other words, I would be expecting it to keep going with wave C, so how would I know? Is it just because, well, it pulled back to a D that therefore I can assume that there's a high likelihood that there's going to be a D?
Yes, yes. If you can draw this harmonic pattern, then you have to say, that's a shorter wave C. Let's watch the price action there once we get there, and let's see what happens. Then you look at the price action. So here you have a morning star candlestick pattern, a 3 candlestick pattern. This is a daily chart, so this is a very powerful pattern. So you have the red candle moving down, you have a hammer, and then you have a strong blue engulfing pattern. You would buy above this the third candle. Okay? Good question. Here's a 2-hour chart for gold. So same thing. Look what happens. We have a 5-wave move down and a 3-wave correction, and then point D. Okay? So naturally, you have to do that additional, you don't just take a position at point D. No, you don't do that. You look at the candlestick pattern, you look at the 1 for a 1, 2, 3 reversal. But you're prepared at that level. At that level, you're saying, okay, this is my level. And you might use other areas of support and resistance. I'm just touching on the highlights, the basics, right? Okay. This is Ethereum. So this pattern was drawn before price hit the D level, and then it hit the D level, and then it reversed. Okay? Here's the Euro New Zealand chart. This was drawn before the point D was reached. And this is the same chart. The point D was reached, and then it turned around. So these are some of the charts that we look at in our trading room, in our that we look at. So all I'm saying is it's brilliant stuff, combining everything. It's advanced, okay? It's advanced stuff, but it's just fantastic. I get really, really excited about this. So let me see if let's summarize. I have a few more minutes, hopefully, because we started late. Yeah? So let's summarize. And we started out by looking at the 8-wave cycle. This is the 8-wave Elliott Wave cycle, where we want to buy, we like 3-wave moves. So we want to buy the wave 2 for the wave 3. We could buy the wave 4 for the wave 5. And we want to sell the wave B for the wave C. So the easiest moves are going to be the C wave and the wave 3. Okay? Everything moves in 3s at a minimum. So then we discussed a 3-point checklist, as it were, if you will, for knowing that we're still in the trend. We have oscillator convergence, we have price in the channel, and we have 1, 2, 3 trend continuation trades. So even with price in the channel, you'd be able to draw your channel lines and buy at the channel support if we haven't completed the 5-wave cycle yet. And then we have the change in trend. Divergence, we have our trend line break, and we have the 1, 2, 3 reversal. And here is the harmonic pattern which lines up with the 8-wave Elliott Wave cycle. That's what we discussed today. Now, I just want to share with you a service that we have. I think I can do this at the end of the presentation. When I was trading at the bank, I was the British pound trader for JP Morgan for 14 years. And I didn't trade the British pound for all 14 years. But anyway, at the beginning of my career, I did. And we had an analyst that we hired from the Chicago Board of Trade, and he was on the desk. and he did our analysis for us. He did the Elliott Wave analysis, he did the pivot point analysis. He basically told the whole desk of traders, there were like 20 of us, what the different levels are for the various currency pairs, okay? So I relied on him. He was like my strategist. I personally didn't really learn this on my own until I left the bank and went out on my own. Then I really had to learn it on my own. And believe me, I had to go up this steep learning curve also. I knew it, but I wasn't an Elliott Wave counter. I relied on somebody. So anyway, I did learn it on my own. But what I did was I designed a service for you. We count and you trade, so that you have your personal Elliott Wave analyst and strategist by your side while you're first starting out. So this is our premium full access. We do wave counts every single day with a video on 16 different markets. Here they are, 5 currencies, actually 6 currency pairs, 5 indices, the S&P, the Dow, the NASDAQ, the Russell, and the DAX, the 10-year bond, gold, oil, and then 2 cryptocurrencies, Bitcoin and Ethereum. Plus, we have trading alerts. As of today, we're up 2,563 pips since January. It's 400 pips on average per month. And here is the equity curve. Now, the return is 78.61. This is an actual account, our actual trading account from these signals. And the maximum drawdown has been 6.48%. Now I'm showing you this because this is a really fantastic performance. We started out talking about keeping your losses small and riding your profits is because the losses are 30 pips, but the profits are 100, 200, 300 pips. That's what it takes to have good performance. And that's really what it takes. And I did sit in on a few sessions yesterday, because sometimes it's nice for me to sit on other people's sessions. I heard the exact same thing. Keep your losses small, ride your profits. And it's so true. You know, every trader, every successful trader will tell you that. And they've learned the hard way. I've learned the hard way. So this is our service. And we also, it's for $17 a month, okay? And you get a 4-module seminar. The sign-up link is elliottwavedesk.com/trading alerts, and gets you daily wave counts on 16 markets. Plus, this is a great way to get started, and it's Elliott Wave. Plus, you get Module 1 of the Elliott Wave series, which is our Elliott Wave course. So you really have like a full Elliott Wave training with this when you're starting out. So now I'm going to take questions. If we have another couple minutes for questions, I'm happy to do that. So, any questions? The accuracy on the wave counts? Well, you saw the accuracy on the trade alerts. Okay?
Yeah, maybe I assume when you count, when you alert the people, right?
Yeah, I mean, on the daily videos, we tell you exactly where you would get in, like what the wave counts are and what we're expecting. So it's not just giving you wave counts, it's talking you through the wave counts. And the trading alert service is discussed in the videos. Yeah, but every trader is different, you know? Every trader is different, so yeah.
Does your service include the harmonics that you're talking about?
Sometimes we will put harmonic patterns on it, but not usually. No, because we have a complete course for that to teach you about the harmonics. We have a complete program. This is just the Elliott Wave. We will put the harmonic pattern in the video, but it's not real, not every day, I would say. Yeah.
Can you talk about course offerings and the pricing of those?
Sure. If you want to write down the website, elliottwaveultimate.com. The full program is $1,600, elliottwaveultimate.com. You can go to my website, fxtradersedge.com, and it's on there. Okay, fxtradersedge.com. Yeah. Any other questions about, did you learn something today?
Yeah.
Yeah? Do you have a better understanding of Elliott and Fibonacci and harmonics and how it all works together? Yeah? Yeah.
I see your chart is mostly daily chart, right?
The charts are mostly down. No, we do analysis on daily, 4-hour, and hourly every day.
Oh, you do average.
Yeah, yeah.
So the average chart, you also work with
The hourly chart, we also label the hourly chart, and we talk through the hourly chart. Yeah, that's what we base our trading decisions on.
Oh, it's the average chart.
Yeah, yeah. Yes.
If you have a stock that is in a long-term horizontal channel,
Okay.
is this applied basically in smaller amplitude movements within the channel, so you're trying to actually buy the bottom?
You can, absolutely. If that's a daily chart or a weekly chart, you can
Let's
actually...
say it's over a year on a daily chart, it's horizontal channel. I'm not quite sure what value this adds.
Oh my gosh, well, first of all, why are you going to even trade that stock unless you want to buy the...
That's what you do, but
Okay, but yeah,
in theory,
in theory, if
physical
you...
manifestation of this should be everywhere, right?
It
Even
is.
though this happens to be in the horizontal channel.
That would be one of the corrections. And if you go down to a smaller time frame, because the markets are fractal,
You chop up and spread it out.
you'll see the patterns.
Inside there, in terms of higher frequency, smaller amplitude inside the channel.
Yeah, absolutely. You'll be able to draw your channel lines. Yeah.
So it confirms your buy-sell within the channel. You're trying to play the channel barrier itself.
It does confirm, exactly, because you're going to have the move down, you'll have the same divergence down to the bottom end of that channel, and then you would look for your end of trend, the 3 points that we discussed, and you'd be able to buy it for the move up to the top end of the channel. Absolutely. The horizontal channel.
Right.
Absolutely. Yeah. Any other questions? All right. Oh, yeah? One more?
Best indicator for the beginning of a wave two. Sorry, the beginning of a wave three and a wave two.
Well, we use a moving average setup. So once the moving averages spread apart, that's really the beginning of a wave three. Okay, so once the smaller average crosses the longer average and spreads apart between 12 and 2 o'clock on a clock face, that's it. That's it. Price moves first, then the shorter term moving averages, then the longer term moving averages are starting to. We have a whole program which describes exactly how to do that. Yeah. But that's probably the best way to see. Anything else? Well, I want to thank you guys for being here. Thank you so much. And I wish you much success in your trading. And I'll be outside of the room if you have any questions, any further questions. Thank you.